Okay, so Noah and I are going to talk about equity and debt securities. So there's three types of securities that we're looking at. So equity securities, these are securities that a firm issues shares to an investor, and the investor then lends the money in exchange for a portion of the firm. And then some debt securities are a firm borrows money from an investor, and the investor lends money and receives a claim of the firm's debt securities. So it works a little differently than equity securities, but you're both owning part of the business. And then derivative securities is the right to trade an existing security at a specified price and date in the future. And these usually derive their value from an underlying asset or some kind of underlying equity that these are getting their value from. And then a couple features of equity. So these have 4 features. All equities have these 4 features, but the way that these features are used is usually different. So the life is how long the security lasts. So this could be 6 months short term, 1 year short term, or it could be 3 to 5 years midterm, or 5 to 10 if you're talking about long term lifespans. And then par value is the amount of which security is issued for or is redeemable for. So this is a lot with bonds, but every equity has some kind of par value. And next we have voting rights. This is whether the security comes with rights to vote on corporate actions. So this can include elected board of directors, shareholder issues that come up, or generally any kind of corporate governing. And then the cash flow rights are where the security pays a dividend and what order the par value gets paid if a liquidation occurs for the firm. So these are going to be your bond payments, coupon payments, bonds, or your dividends from stocks, kind of things like that. Those are cash flow rights. And we'll talk about this a little bit later, but different equities have different pecking orders, I guess you could say, when it comes to liquidation. Different pecking orders, I guess you could say, when it comes to liquidation.
So common stock is going to be the first type of equity that we talk about. Common stock does not expire. Its par value is really low or zero, and this is just like a legal thing that companies do, and then it helps when they're liquidating assets and paying people out. Cash flow rights. So for common stock, they're kind of at the bottom of the food chain. They still can get dividends, but they're not guaranteed to receive them. And then if the company is liquidated, they receive benefits after liabilities and preferred shares. So they're least likely to get anything after liquidation because usually the liabilities and the preferred shares strip the company up. For common stock has voting rights, and it's often split into 2 classes. Class A has more voting rights than B, so usually sometimes they'll get like 15 votes per one stock that they own, while Class B has less voting rights, usually just like a 1-to-1 ratio. Voting doesn't really matter for the average investor because you're never going to hold enough stock in a company to really sway it. Voting rights matter more to these large institutional investment places that they can control a fair amount of the company, so voting matters way more to them. Okay.
So an example of one of these common stocks is General Electric. So GE has been traded on the New York Stock Exchange. You can just see that a couple information here. So we have a dividend yield of, about 0.62%. So kind of a low dividend yield, but this is also a common stock that doesn't require a dividend. So it's kind of a bonus that comes with this GE common stock. And there's multiple examples of this. If you just go on Yahoo Finance, play with the symbol lookup, you can find a bunch of securities there, and those are just mainly going to be common stocks. like this example here, like General Electric.
Okay, so preferred stock. Preferred stock, these can have a maturity date, but usually they don't, and they don't necessarily have to. So these can last as long as the company lasts. The par value of these is just what the value is issued at. So this is what they sell for initially. Voting rights, preferred stock does not have any voting rights. Where preferred stock is preferred in my mind is cash flow wise. Preferred stocks very often have consistent negotiated dividends that unless if the company is going through like a financial disaster, they're going to be paying out these dividends. So it's kind of expensive for a company to issue preferred stock. And then upon liquidation, they get paid out before common stockholders, but after liabilities are paid. So in my mind, preferred stock is they're preferred to the money, so they get all the money really quick, but they don't get voting rights.
Yep. And so for example, preferred stock is Arbor Realty. So this is Arbor Realty Trust preferred stock, and its ticker is ABR/PA. Kind of got a straight ticker symbol there, but the P is for the preferred stock, and then A is just the class that we're talking about, the Class A and Class B that we were talking about earlier. So if we look at this stock, it looks a little bit different than that GE common stock. Like Noah was talking about, the dividend yield you can see here is 8.74% compared to that point, I think, what was it, 64% for GE. You can see that the cash flow is keying here because with preferred dividends, they are expecting and requiring a dividend. So that's why you're seeing high dividend yields for a lot of preferred stock.
Convertible bonds. They function just like bonds until a conversion occurs. So the life of a convertible bond, these expire, so you don't always have the ability to convert your bond to common stock. The par value is what the bond will pay back after expiration. Usually bond par value is just $1,000, but it isn't necessarily the case. Voting rights, these don't have any voting rights unless if you convert them to common stock, and then they have the same voting rights as common stock. And then cash flow rights, convertible bonds are a liability for the issuing firm. Upon liquidation, they must be paid out first. So these bonds pay out a consistent coupon payment is what they call it. So it's kind of like a dividend, but like also not really. And then these are higher up in the pecking order upon liquidation. So these get paid off at the same time debts get paid off. So the thing about convertible bonds is you buy one of these and then you can either choose to convert it if it looks like the stock is doing well and you'd rather have common stock, or you can just hold on to the convertible bond. Usually these bonds pay out a smaller coupon payment than regular bonds because you have the advantage of being able to convert them back into common stock. So you kind of get to live in both areas because you can either play it out like a safe bond, or you can convert it if common stock is looking like the best choice. And then there is a conversion ratio, and this tells you how many stock you get per bond. So you would only like convert if so they're typically only utilized when the stock price times the conversion ratio is greater than the value of the bond.
All right, so an example of a convertible bond was from a company called Navistar. They issued a convertible bonds on October 22nd, 2009, and they had a maturity date on October 15th, 2014, so a 5-year kind of a midterm period. So the bond had a semi-annual payment at a rate of 3%. So they pay 2 payments each year for 3% of the bond's value. And then the owner had the option to exchange each $1,000 bond for 19.8 common shares. So on October 22nd, 2009, when the bond was first issued, the stock price for Navistar was $37.24. So the bond's conversion value would have been that $34.24 times that 19 1989 in common shares. So that gives us the conversion value for the bond would be $740.70 if they wanted to convert when the bond was issued. And so looking at when the bond expired on October 15th, 2014, 5 years later, the stock price dropped to 31.73. So the bond conversion value is going to be lower. And so the calculation for that would be that $31.73 stock price and that 1989 in common shares. So that would give you the bond conversion value as of October 15th, 2014 of $631.11.
Okay, warrants. These are often referred to as employee stock options. So these allow the owner of the warrant to buy a set amount of stocks for a set price within a set time period. So these expire, usually they last a few years. The par value is the set price per share the warrant holder pays. These have no voting rights and no cash flow rights. So effectively what these allow you to do is these allow you to, like if the stock price goes up, but your warrant allows you to buy prices below the stock price, you can make instant money because you can just buy the stocks and sell them, or you can do whatever you want with them, but you get instant value from buying stocks at a lower rate than the market offers. So these are something a company offers, like employees, to incentivize them. They're often found in like corporate benefit packages and stuff like that, like for the CEO, things like that. That's where these are used.
All right. So an example of a warrant. So Berkshire Hathaway did a deal with Bank of America for preferred stock and warrants. So Berkshire Hathaway invested $5 billion into Bank of America in exchange for its preferred stock. So the preferred stock had a fixed dividend of 6% per year, which was redeemable by Bank of America at any time at a 5% premium to the $5 billion par value. So it was a pretty good deal for Berkshire. But on top of that deal, Berkshire Hathaway also received warrants to purchase 700 million shares of Bank of America common stock at an exercise price of about $7 per share. So that exercise price of $7 per share was most likely lower than the market price of Bank of America's common stock. So that was an added value for Berkshire Hathaway. So the warrants can be exercised at any time during a 10-year following the closing date of the transaction. So it was kind of the icing on the cake. The warrants were being used for Berkshire Hathaway, and they just got that extra shares and from Bank of America at that set price, which is going to be really good for them, especially if that price is below the market price when they made the deal.
Okay, so depository receipts. This is the last equity security. So what depository receipts do is they make foreign investing easier. So how they work is financial institutions like a bank will buy foreign stock and then sell them locally to people. It's much easier to go through like a local financial institution than to shop on international foreign exchange markets or international markets. And then you also have to deal with the conversion, you have to deal with certain fees, and then there's certain fees for buying because you're not in the country. So these work really similar to common stock, just to try to understand them. The lifespan is infinite. The par value is the price specified by the issuing bank. Voting rights, usually the financial institution will keep them. I imagine unless if you were buying a whole bunch of them, you wouldn't be able to get the voting rights. So the bank gets to choose on any voting matters. Cash flow rights, you still get dividends, like if dividends are paid out to common stockholders. And then upon liquidation, you can receive the par value after liabilities and preferred shares are paid out. So they're at the bottom of the pecking order, similar to common stock. So the issue with these is they're not very liquid because they're not on a stock market. So often trying to find someone to buy them off you is more difficult. but people like them and they help international trade a lot because they just simplify things, and you can avoid a lot of fees and currency conversion issues.
Yep. So an example of these depository receipts um, is this company called Vale. So Vale is a Brazilian mining company, so not in the U.S., and they are traded on the New York Stock Exchange. So the way that they do this is through the depository receipts. Um, so kind of going through the stock ticker, so we have Vale, South America, and then American Depository Receipt, which is the ADR. And you can see it's just similar to our preferred stock and our common stock. Very similar features. They can be, you can tell their dividend yield, their earnings date, their earnings per share, just like you can with common or preferred stock. So very similar in that way. The benefits of these are, again, that easy convenience into foreign equities or foreign securities, and kind of a way to diversify into foreign securities without those heavy price tags. And that's all we got.
Anyway, I pretty much have only 3 questions for you
Okay.
guys, and so the first one is it's my own personal question. Is I think that you were talking about this. Is why would you invest in a Class B over Class A if the Class A gives you more voting power?
They're different prices, so they go for different rates.
Mm-hmm.
So usually Class A stocks cost more. And if you're just like an average investor and you don't want to be holding these big stocks, you'd rather have more. That's why. But I mean, just for the most part, it doesn't really matter to people.
Mm-hmm.
So it's just fine to get Class B stocks because you still hold the same percentage of the company. Usually
Okay.
Class A stocks just cost more. So
And would you say people sometimes wouldn't want the burden of having the vote?
yeah, I mean, and I think a lot of votes actually go wasted for people that have Class A stocks that only have a few,
Mm-hmm.
just because it doesn't really, sway the company enough.
I gotcha. Okay, my second question is talking about warrants, and the question is, would a warrant be considered discounted equity because investors are buying it at lower rates, or exactly how does that work? I'm sorry,
Yeah.
it's a little
So
general.
basically, the warrant is for a security at a specified price at a specified date and time. So it's usually discounted to what the market price is when they make the warrant deal. So let's say you're trading Apple stock and Apple stock's at $300 per share market value. With a warrant, it allows the person to buy in at, like, let's say $295. So you're saving that $5 off market price with the warrant. That's kind of how those, like a basic of how those are working. An example of those are just like stock options, which is just like that example with Apple, being able to buy at $295 instead of the market price of $300. But there's usually a time value added to warrants, similar to bonds. So you got to take that into consideration also.
Okay, all right. And then my third and final question that I have is, when you guys were, Abazi, I think that this was you were explaining how Vale, the Brazilian mining company, was being traded in the U.S. Stock Exchange, or the New York Stock Exchange, I believe. I apologize if I'm incorrect. Just like how, could you explain how how the depository receipt works for that example again? I'm sorry.
Sure, no problem. So you're going to have a bank that buys, for example, let's take Vail. So you're going to have a big bank that buys up a number of shares, let's say $10 million of shares outstanding for Vail. So they're going to buy that first party directly from Vail internationally. They're going to be paying that conversion fee from US dollars to currency in Brazil. I'm not exactly sure what that is. So they're paying directly from Vail or from like an international marketplace, and they're bringing those shares to the US marketplace. So they take that 10 million shares that they bought from the international marketplace or from the international company directly, and they're basically just pushing it onto like a US marketplace like the New York Stock Exchange, NASDAQ, stuff like that. So yeah, that's basically what they're doing there. And so that's what they mean by American Depository Receipt. It's just basically converting that international security to mimic a domestic security, basically.
Okay. All right. Well, that's pretty much all I had for you guys. You know, you guys were you guys had a very good presentation. You know, and I don't know if you guys have anything that you wanted to talk about. I know I'm pretty sure this is going to be posted as well. So if you had any other information that you wanted to share with everybody, feel free to.
I think that's basically all we wanted to go over.
Yeah, no, I'm good. A lot of this ended up getting covered.
Yeah. So, well, I really appreciate it, guys, and I'm going to try to figure out how to stop recording this.
All right.